Hello everyone, this is Dr. Hessa Al-Fadhel, the course coordinator of Accounting 112. In this video, I'm going to explain Chapter 1, Part 2. The learning objective A1 is to define and interpret the accounting equation and each of its components. So let's get started. First, this is very important. You need to make sure that you understand what is the accounting equation. The accounting equation includes three main components. Assets equals to liabilities plus equity. Now, let us first understand the first component of the accounting equation. What is asset? Assets are the resources owned or controlled by the company. And we have examples of assets: cash, note receivable, land, buildings, equipment, store supplies, vehicles, and account receivable. Let me give you an example to clarify what does asset means. Let's take the example of University of Bahrain. The College of Business building, it's an asset to University of Bahrain. Why should I call it an asset? Because University of Bahrain own this building and they can control it. Therefore, I can call it as an asset. Equipment. If the company own equipment and they can control it, then I can call it as an asset. Let's give an example again. University of Bahrain, they do have all of the PCs. All of the PCs in University of Bahrain are considered to be an equipment. So the PCs in universities in Bahrain, they're considered as an asset. Why? Because it's owned and controlled by University of Bahrain. That's why I can call them as an asset. The vehicles. All of the security vehicles that are used and the buses that are used in University of Bahrain, we can call them as an asset. Why? Because they're owned and controlled by University of Bahrain. Store supplies. So what do I mean by store supplies? Store supplies could be, for example, stationery in the company. If the company have a stationery, so we can call them as an asset. Why? Because it's owned and controlled again by the company. A land. If University of Bahrain, they own a land also will be considered as an asset in this case. What is account receivable? Let me now explain account receivable with an example. This is very important. Listen carefully. Okay, let's take an example of account receivable. Again, account receivable, it's part of the asset. But what does account receivable means? Account receivable means the cash that I'm expected to receive from the customer. To make it more clear, let's see this example. We have a company called Tech Company. Tech Company, they sell PC for 400 BD to Diamond Company. So Tech Company, they sell a PC of 400 BD to Diamond Company on credit. What do I mean by on credit? On credit means that Tech Company, they did not receive the cash yet from Diamond Company. They did not receive the cash, but they are expecting to receive the cash in the future. So in this case, Tech Company will record it as an account receivable. So account receivable, it means that the company did a sales transaction on credit, which means they did not receive the cash yet from the customer, but they are expecting to receive it in the future. Therefore, we are going to record it as an account receivable. Now, let's move on with the next component of the accounting equation. Before we said that the accounting equation, it's about assets equals to liability plus equity. So what is a liabilities? Liabilities means creditors' claims on assets. Or in other means, it means the obligation or the responsibility of the company to pay the money back. And the examples of the liability are notes payable, wages payable, tax payable, and accounts payable. So let us explain accounts payable in detail. Let's jump directly to the example. We have a Smith company. They purchase PC this time. They did not sell, they purchased. So Smith company, they purchase a PC for 400 BD from M&H company on credit. Smith company purchase PC of 400 BD from M&H company on credit. What does that mean? It means that Smith company, they did not pay the money yet to M&H company. So Smith purchased it on credit, or sometimes we can call it on account. So now Smith company, they have an obligation to pay 400 BD to M&H. So in this case, Smith company will record it as an accounts payable. So accounts payable means that company purchases from another company on credit. So me as a company, Smith company, the company that purchases the PC, I have now an obligation. Another example of the liabilities. Another example of liabilities, which is wages payable. Let us jump first to the example. Every 26th of each month, H&H company, they pay wages to the workers. So every 26th of each month, the company has a responsibility to pay wages to the worker. On the 26th of January 2020, H&H, the company, they did not pay the worker yet, but they have to pay them. So we know that every 26th of each month, H&H company, they have to pay the workers. But on the 26th, they did not pay them. But they have to pay them. So now H&H, they have an obligation or responsibility. What is the H&H company responsibility? They have a responsibility to pay the money to the workers. So in this case, H&H company will record the wages as wages payable because it's liability to them to pay to the workers. Let's move on with the last component of the accounting equation, which is equity, which is owner's claims on assets. Under the equity, we have 3 or 4 components. You have to remember, equity includes 4 components. The first component is the owner capital. What do I mean by the owner's capital? Here I mean by the owner's investments. So when the company decide, if the owner decide to start up a company, he needs to put the money to start up the business. So this money that we use to start up the business, we call it owner's capital. The second component of the equity is owner's withdrawals. What do I mean by the owner's withdrawals? Owner withdrawals, it means that if I have a business and I'm an owner, I can withdraw some money outside of the company. Now, the owner capital means when I start up a business, I'm putting money inside the business. That's why the owner capital will increase my equity. But if I have owner's withdrawals, it means my equity is going to be reduced. Why? Because I'm withdrawing money outside the company. So owner withdrawals will decrease the equity. Owner's capital, which means that I'm starting up a business and I'm putting money inside my business, then owner's capital always will increase my equity. The third component of the equity is revenue. Revenue means that if I completed a service and I receive cash, I'm going to record it as a revenue. Revenue means that the company is getting cash inside the company. So that's why revenue always will increase the equity. The fourth component of the equity is expenses. What do I mean by the expenses? Expenses means that the cash that I'm going to spend, so there is a cash outflow. There is cash is going outside the company. Revenue means cash coming to inside the company. That's why we say revenues, it means cash increase. Expenses means cash decrease because I'm expensing the money. I'm taking the money outside of my pocket to pay, for example, for any kind of expenses. One of the examples of the expenses that the company needs to pay I would say in a monthly basis, which is the rent. If the company is renting the building, then they have to pay rent. Rent, it's an expense. Why I'm going to call it as an expense? Because I'm paying cash outside of my pocket. So that's why I'm going to call it as an expenses. Expenses will always reduce the equity. Again, to sum up the components of the equity, equity consists of four components: owner's capital, owner's withdrawal, revenue, and expenses. Owner's capital and owner's capital and revenue both will increase the equity. Owner's withdrawal and expenses will reduce the equity. So overall, by now you should know that the accounting equation, its assets equals to liabilities plus equity. Moving now to the learning objective P1. Analyze the business transaction using the accounting equation. As I said earlier, in Chapter 1, Part 1, transaction means that the company is doing either purchases or sales. Transaction. So there is an event happening in the company. Now, we're going to analyze those business transactions using the accounting equation. Okay, let's start with transaction 1. The first transaction says that Chess Tyler invested $30,000 cash to start up a business. This business called or named Fast Forward. So now the investor, whenever you see this kind of a transaction, you have to remember that I have an owner, he wants to start up a business, so he put some money because I cannot start up a business without money, of course. So what he did, the investor, he put $30,000 cash inside the business. So you have to remember, two things will be increases. Because I put cash into the company, so the cash will increases. Not only the cash will increases, the owner's capital also will increase. Cash, it's an asset and it will increase. Capital also will increase, and capital is part of the equity. So you have to remember, whenever you see a transaction says that investor invested money to start up a business, you should by default remember that cash and capital will increase. Let's move to transaction 2. Company purchase supplies by paying $2,500 cash. Okay, let's analyze this transaction. So I have a company and they purchase supplies. We know that supplies, it's an asset. Okay, supply, it's an asset. If I purchase supplies, it means my supplies is increasing. What else? So I purchase, in order to purchase the supply, I paid cash. So what's happening to my cash at the moment? My cash will be decreased. Why? Because I'm paying. We say pay, it means there is money will go outside from my pocket. So it means the cash is going to decrease, and the cash, it's an asset. The supplies, because I purchase supplies, my supplies is increasing. Transaction 3. The transaction 3, we have the company purchased equipment for $26,000 cash. Again, we purchase. What we did, we purchase equipment. Equipment, it's an asset. And whenever you purchase something, or whenever you purchase equipment, it means my equipment is increasing. But when I purchase it, did I pay cash? Yes, I did. I pay 26,000 cash. So my equipment will increase and my cash will decrease. So cash will decrease. Why it is decreasing? Because I purchase, which means that I pay cash outside from my pocket. That's why the cash is decreasing. Equipment, it's an asset, but since I purchase it, it means my equipment is increasing. Move to transaction 4. In this transaction, they say that the company purchased supplies. So we purchase supplies. We know supplies, it's an asset. We purchased the supplies for 7,100 on credit. What does on credit means? If you remember me, it means that the company purchased but they did not pay yet. If you did not pay yet, it means that now the company has an obligation or responsibility to pay it back. So now, what will increase or what will decrease? Of course, because I purchase supplies, my supplies is going to increase, and supplies, it's an asset. But because I purchase on credit, it means I have an accounts payable. Why accounts payable? Because I purchase on credit. It means I did not pay yet and I have to pay. So now my responsibility or my liability or my obligation is increasing as well. Let's move now to transaction number 5. So we said here, we have a company, they provided a consulting services to a customer and received 4,200 cash right away. So if you read this carefully, they say that the company provided consulting services. If you go back and see provided, it's in the past tense, which means that the company already provided the services and they completed, and then they receive cash of 4,200 because I provide a service and I completed. The main important part is I completed the service and I received then cash of 4,200. So my cash definitely is increasing, okay? And my revenue is also increasing. Revenues is part of the equity and cash part of the asset. Why did I recorded this cash as a revenue? Because if you remember, based on the revenue recognition principle, go back to chapter 1, part 1, and revise this part. We said that we are going to record the cash as a revenue if the service is completed. So I complete the service, so therefore I'm going to record it as a revenue. Okay? And I receive the money right after and cash, then my cash is increasing. Okay, let's move on with transaction 6 and 7. The company paid rent of $1,000 and salaries for 700 to employees. There is a magical word here, paid. Whenever you see paid, so you have to remember, if the company is paying, definitely the cash is reducing. But which kind of payment the company is doing? The company is paying a rent. We know that the rent, we pay it on a monthly basis. So this is an expense. So the rent here is an expense. Again, salary is also an expense because to me as a company, if I have an employees and I'm going to pay them salary every month, this is an expense to me. Why? Because I'm going to take cash outside of the company and pay it to the employees. So now what will happen? If I'm paying rent it's an expense. If I have salaries it's an expense as well. So my rent, my expenses is going to increase and my cash is going to decrease. So cash, it's an asset. Rent expense, it's an equities and it's going to increase. Salaries, it's expense and it's going to increase. And cash is going to decrease. So now my question here, why the rent expenses and salaries expenses are increasing? Because it means that my expenses is increasing. I'm paying out lots of money. Why cash is decreasing? Because the company is paying the salaries and the rent as a cash, in a cash form. Let's move on to transaction 8. Here, we provided a consultant services. Now, the company they provide the services and they completed. For how much? For 1,600, and rent facilities, also another type of revenues. They have a rent revenue for 300 to a customer for credit. So though the company provided a service, two type of services, consulting services and rent facility services to a customer, but for credit. I'm going to ask you now one question. So this is a service, and the service is completed, provided. So I'm going to record, because since the service is completed, then I can record it as a revenue. But my question, service is completed, but did I receive any cash? Not at all, because I provided the service on credit. It means that I'm still waiting for the customer to pay me the cash. So how am I going to record it? So in this case, if I'm expecting the money from the customer to be received in future, then I'm going to say account receivable. And account receivable, it's an asset and it's going to increase. Why increase? Because I'm expecting to receive the cash from the customer, and because the service is completed already, I completed the service, but I'm still waiting for the money to be received, then I'm going to record it as a revenue or consulting revenue, because the company provided two type of service. Remember that they provided a consulting services service, and they provided a rental service. So I have two type of revenues, consulting revenues and rental revenues, and three of these accounts are increasing. Again, just to make things more clear, provided consulting services, it means that the company provide the services and they complete it. So if the service is completed, then I can record it as a revenue directly. And revenue, it's part of the equity. Why account receivable? Because I did not receive from the customer money yet. I provided a service on credit. It means I did not receive the money yet, but I'm expecting to receive it in the future. So that's why I recorded account receivable, and the account receivable is increasing, and account receivable is part of the asset. Let's move on with transaction 9. In transaction 9, the client in transaction 8 pays 1,900 for consulting services. Go back to your notes to transaction 8. In transaction 8, we provided a service to the customer. If you can remember, we just provided a service, two services to the customer. One is consulting and other is rental revenue. So the total was 1,900. And in transaction 8, we said that the company provided services on credit, and we recorded as accounts payable. Why in transaction 8 we recorded as accounts payable? Because we provided service and we completed, but we did not receive the money yet from the customer. Therefore, we recorded as accounts receivable. But now in transaction 9, the client came back to me and paid me 1,900. So how am I going to record here the transaction? I'm going to, because the customer just paid me the money, so my cash is going to increase, and the cash, it's an asset, and my account receivable will decrease, and it's an asset. Why my account receivable is decreased? Because I received the money already from the customer. Before, because I did not, in transaction 8, I did not receive the money from the customer. That's why I say account receivable is increasing. But now the customer came to me and paid me the money in cash. That's why my cash is increasing and my account receivable is decreasing. Why account receivable is decreasing? Because I already received the money from the customer. Okay, so make sure you have to be careful. If there is a transaction, you have to read the transaction carefully. So now Go back to transaction 8, read it carefully, and then come back to transaction 9, and then you'll get the logic. Okay, let's move on with transaction 10. Fast forward, they pays 900 as a partial payment of supplies purchased in transaction 4. So let's go to transaction 4. What happened in transaction 4? In transaction 4, if you can remember, or you can go back to transaction 4, and you will see that we already analyzed the transaction, and the transaction was the company purchased supplies for 7,100 on credit. And we recorded, since the company is purchasing supplies, we said that the supplies is going to increase. And we said that since the company purchases the supplies on credit, then the company now have a liability to pay back the money to the seller. Okay, so now me as a company in transaction 10, now I'm going back and I'm going to pay the 900. Going to pay the 900. Why I'm paying the 900? Because I already purchased the supplies on credit and I have a liability to pay it. So you have to remember one thing. If the company is going to do payment, it means the cash is going to be reduced, or cash is going to decrease. And cash, it's an asset. What else also will decrease? My accounts payable. Why my accounts payable and my cash is going to decrease? I know that the cash is going to decrease because the company is paying, so there will be cash outside the company. My accounts payable is going to decrease because I paid my liability or my obligation. So that's why my accounts payable is reducing. Now let's move on to 11. Owner withdrawal 200 cash for a personal use. What does owner withdrawal? It means that if I own a company and I needed some money, I went to the company and I took 200 out from the company, a cash. I withdraw a cash. So what will happen here? Since I withdraw money, it means that my cash, and cash is an asset, is going to decrease. What about the owner's withdrawal? The owner's withdrawal is going to increase. Why is going to increase? It means that I'm withdrawing out money from the company. So my withdrawal is increasing. Why cash is reducing? Because I'm taking money outside of the company. Okay, the learning objective P2 is to identify and prepare basic financial statements and explain how they interrelate. In accounting, we have 4 financial statements that each and every company needs to prepare by the end of each year. The first statement that they have to prepare is income statement, followed by statements of owner's equity, followed by balance sheet, and finally statements of cash flow. In this course, Account 112, we will learn how to prepare the first 3 statements. Statement of cash flow is not included in this course. So let's see how we can prepare the income statement. Now we'll learn how to prepare the income statement. But first, before preparing the income statement, you need to make sure that you need to start with the company name at the first line. As shown here, Fast Forward is the company name. The second line, you need to state which statement you are preparing. In our case, now we are going to prepare income statement, therefore we wrote income statement. The third line, you need to state the period or the time or the year or the month that you are going to prepare the income statement in. For example, for the month ended December 31st, 2019. As I mentioned earlier, all of the financial statements usually prepared by the end of the year. To prepare the income statement, you need to remember that there are 2 main items that it should be included: revenues and expenses. First, you need to list all of the revenues in the company under the revenues. So we have here consulting revenue and we have rental revenue. Then I'm going to take the total revenue. Under the expenses, I'm going to list all of the expenses that I have in the company. In our case, we have rent expense and salaries expenses. Then I'm going to take the total of expense. To know that if the company is doing profit, or what we call it net income or net loss, I need to take the total revenue minus the total expense. Then I'm going to know if I'm doing net income or net losses. In our case, it's a net income of 4,400. Why? Because my total revenue is greater than my total expense. Just to remind you again that when you're preparing the financial statement, you have to remember that you have to do it in order, which means that you always have to start with income statement, then statements of owner's equity, then the balance sheet. You should do them in order. So since we're done with the income statement, now we are going to prepare the statements of owner's equity. And the statements of owner's equity, we always start with the beginning capital. In our case, the beginning capital is 0. But in some questions or in some exercises, they might give you the beginning capital as a number. If they did, then write it down. Then you need to put plus and less. What you're going to include under the plus, you're going to include if there is any investment by the owner, it will increases the equity. So that's why you are going to put any investment in the plus side. If there is any net income, a net income will increase the equity. So that's why you are going to add it in the plus side. What I'm going to include in the less side. In the less side, if there is any withdrawals will reduce my equity. That's why I'm going to add it in the less section. If there is net losses would decrease my equity. So that's why I'm going to add it in the less side. So in our example, we do have here owner's investment. If we have investment, then I'm going to add it in the plus side. Why I'm going to add it in the plus side? Because investment increases the equity. If you remember, when we prepared just now the income statement, we had a net income of 4,400. Because I have a net income, then I'm going to add it on the plus side. If I have net loss, then I'm going to put it in the less side. Now, we have withdrawals by the owner. If we have withdrawals always will reduce my equity. So now I have the total plus, which is total investment and income, is 34,400. 34,400 minus the withdrawal will give me ending capital of 34,200. So you have to remember, while we are preparing the statements of owner's equity in order to calculate how much is my ending capital at the end of the year, how much is my capital. So we can see that at the beginning of the year I have 0, but then I have some investment, then I have some net income, then I have some withdrawal, then how much is my ending capital now? It's 34,200. So the purpose of doing these statements of equity is to calculate the ending capital. To do so, we need to start with the beginning capital. Then we have plus and less. You have to remember, any investment will increase the equity. Any net income will increase the equity. Any withdrawal will decrease the equity. And if there is any losses, net losses, then also it will decrease the equity. Then the total of the plus side minus the less side will give me the ending capital. So you have to remember that the capital 34,200. Now we're going to learn how to prepare the balance sheet. Again, you have to start with the company name in the first line, then the statement, which is the balance sheet statement, and we are preparing this for December 31st, 2019. Now, if I ask you, what are the components of the accounting equation? The accounting equation, if you can remember, it includes assets, liabilities, and equity. The same thing with the balance sheet. The balance sheet, we have 3 items that we have to include. assets, liabilities, and equity. Make sure that the asset will be in one side and the liabilities and equity in the other side. So the asset will be on your left hand side and the liabilities and equity will be on your right hand side. So what I'm going to do, I'm going to list all of the assets item under the asset. So cash, it's assets. That's why I'm including it under the asset section. Supply, it's also an asset. That's why I'm including it under the asset section. Equipment, it's an asset. That's why I'm including it under the asset section. Then I'm going to take the total asset. If the company, they do have another items of asset, you just put all of the asset under the asset section and they take the total. How much is the total here? It's 40,400. Then liabilities. The company here, they have accounts payable. Accounts payable, it's part of the liabilities. So I'm going to put it under the liabilities and then I'm going to take the total liabilities. Equity. What should I include in the equity? Can I include expenses? No. Why I can't include expenses under the equity? Because I already used the expenses in the income statement. I cannot use it again. Do I include withdrawals? Not at all. Why I can't include any withdrawals? Because the withdrawals, I already use it in the statements of owner's equity. Then, do I need to record any investment here? Not at all. Why? Because I included there in the owner's equity statement. So what I have to include in the balance sheet, I only need to include the ending capital. From where I get the ending capital, I just calculate it in the statements of owner's equity. So that's why I need to make sure that when I'm preparing the income statement, I prepare first the income statement, then statements of owner's equity, and then balance sheet. Why I have to do the balance sheet at the end? Because I need to calculate the ending capital. And the ending capital, from where I'm going to calculate it? From the statements of owner's equity. So if you remember that the accounting equation, it's about asset. The asset should be equals total liabilities plus total equity. So if I add total liabilities, the liabilities is 6,200 plus 34,200, it's going to give me 40,400. You have to remember in the balance sheet, the total asset side should be equals to the total liabilities and equity. In our case, it's equal. If it was not equal, if you are trying to solve an exercise and the balance sheet is not equal, it means that you either have a problem in your balance sheet or your income statement was wrong or the statements of owner's equity was wrong. But if you get balance sheets equal, total asset equals to the total liability, it means that you did it correctly. Thank you very much. This is the end of chapter 1.